Welcome, welcome, and thank you for joining us for another deep dive. We are here to cut through the complexity and give you the essential knowledge you need to be truly well-informed and fast. Before we plunge into today's material, if you appreciate this kind of focused, high-quality analysis, please take a quick second right now, like this deep dive, share it with someone, and definitely subscribe to the channel. Stay tuned for our future content. Your support, well, it really helps us keep these deep dives coming. Today, we are taking on a giant piece of corporate documentation, the Palantir Technologies Inc. Form 10Q for the third quarter, which ended September 30, 2025. Our source is roughly 90 pages of the most granular financial statements, footnotes, legal disclosures, everything the company provides quarterly. Our mission is direct. We are stripping away the jargon and the volume to distill this mountain of data into the 5 most important financial and operational takeaways. We need to understand the true story of their accelerated growth, the depth of their profitability, and, the key strategic risks they're now confronting. Okay, so let's unpack this. This quarter shows Palantir achieving something critical. They're pushing well past that $1 billion revenue mark. And the financial statements, especially when we talk about cash generation, are signaling a big transition in the company's maturity. But we have to look past the press release headlines. What do the real detailed numbers tell us about execution and future challenges, especially that GAAP versus adjusted figure comparison?
That distinction is absolutely the key to this entire filing. For you, the listener, the Form 10Q is our most comprehensive, granular look at the company's health every quarter. Even though the data is unaudited, it's the mandatory report filed with the SEC. It gives us detailed comparisons for the 3 and 9 months that ended September 30, 2025, against the same periods in 2024. And my initial assessment, it really supports your point. The narrative emerging here isn't just one of simple growth, it's accelerated growth. And it's coupled with these remarkable improvements in operational efficiency. They aren't just selling more, they're selling smarter and cheaper relative to the contract size. This pivot is creating a massive leverage event in their financials.
Okay, let's start right at the top with those headline numbers, because they really do confirm the company is operating at a totally new level of scale. Looking specifically at the 3 months ended September 30, 2025, so Q3 2025, the GAAP results show a remarkable financial achievement. Revenue clocked in at a staggering $1.181 billion. And to ground that figure for you, that represents a 63% increase from the $725.5 million they reported in Q3 of 2024.
63%.
Yeah, 63% growth at $1 billion run rate is incredibly difficult to achieve and, to maintain.
And that kind of top-line scale translated directly to a huge lift on the bottom line. Their net income attributable to the common stockholders, it nearly tripled. It hit $475.6 million. That is a massive leap from the $143.5 million from Q3 2024. This isn't just about crossing some arbitrary profitability threshold. This level of GAAP net income, it firmly establishes Palantir as a mature, highly profitable software provider, at least in the eyes of the broader market.
Right, and translating that into the most digestible metric for investors, earnings per share. The basic EPS hit 20 cents. That's up dramatically from 6 cents year over year. And the diluted EPS, which, accounts for the vast number of stock options and RSUs outstanding, which we will definitely discuss extensively later, settled at 18 cents, also up dramatically from 6 cents in the prior year period.
And what's more, even their reported GAAP growth margin improved. It went up 2 points, moved from 80% in Q3 2024 to 82% in Q3 2025. In the high-stakes, highly competitive software sector, maintaining a gross margin in the low 80s as you scale revenue this fast, that is a powerful indicator of pricing power and superior cost controls. They're not having to cut prices to gain that market share.
Now, those Q3 numbers are phenomenal on their own, but as you mentioned, we have to look at the sustained performance across the year. Is this a single blowout quarter, or is it a fundamental shift? So what does that 9-month perspective tell us?
The 9-month year-to-date figures through September 30, they confirm its acceleration and sustainability. Palantir's year-to-date revenue reached $3.07 billion. Crucially, that represents a 51% growth rate over the $2.04 billion they did in the first 9 months of 2024. So this demonstrates that the 63% quarterly growth is an acceleration building on already robust growth.
Okay, so it's not a blip.
Not a blip. And this sustained performance has pushed their year-to-date net income across the symbolic $1 billion mark. Specifically, it landed at $1.02 billion in 2025, compared to just $383.2 million in the same period in 2024. And year-to-date diluted EPS is at 40 cents, compared to 16 cents the previous year. What's fascinating here is that the acceleration is sustained. The 9-month figures confirm it. It gives clear confidence that the strategic shift they made a few years ago, moving toward productized commercial offerings, is bearing significant, sustained fruit.
Right. It's proving a lot of the doubters wrong about their ability to scale outside of those big bespoke government deals.
Exactly.
That sustained growth immediately makes us want to investigate the engines driving this. So let's start our first deep dive here into revenue engines and customer dynamics. Breaking down where that impressive 63% Q3 revenue surge actually came from. Palantir's history, it's rooted in government contracts, but that segment balance, it seems to be shifting very, very rapidly.
The shift is dramatic, and it's critical to dissect the contributions. Let's look at that segment breakdown. The government segment, it still dominates in absolute dollars. It pulled in $632.7 million in Q3 2025. Now, that's a very healthy 55% growth year over year for a segment that size.
55% is still huge.
It is. But here's the strategic nugget. The filing discloses that $205.7 million of that increase came from existing government customers. So those already contracted as of the end of 2024. This shows strong expansion within their established client base.
So they're upselling. It's not just new contracts, it's bigger deals with the people they already have.
Precisely. It implies that government agencies are finding new use cases for platforms like Foundry and are extending their usage.
And the U.S. government remains the massive anchor here, right? It's providing almost 3/4 of that government revenue. U.S. government revenue alone was $485.9 million in Q3. That indicates a deepening penetration and reliance on their platforms within key domestic agencies.
Absolutely. But if you're tracking Palantir's strategic pivot, their effort to de-risk their reliance on that unpredictable government contracting cycle, the commercial segment is the runaway story this quarter. Commercial revenue reached $548.4 million. That reflects a stunning 73% growth year over year in Q3.
73%. So not only is it accelerating faster than government, but it's getting very close to revenue parity with that traditionally larger government segment.
Exactly. It's closing the gap fast.
This is where it gets really interesting for you, the listener, if you're tracking their long-term strategy. Drilling down even further into that commercial side, the growth within the U.S. commercial market is just exceptional.
Yep.
U.S. commercial revenue grew an astonishing 121% in Q3 2025. It leaped to $396.7 million compared to $179.2 million last year.
121%.
That 121% figure, it's not just a number. It is the concrete validation that their shift away from that expensive, bespoke, high-touch consulting model, the old mining approach, is working. It suggests they have successfully productized their offerings, perhaps through modular deployments of their AIP platform, allowing them to shorten sales cycles.
I agree entirely. That 121 U.S. commercial figure is, arguably, the single most powerful operational data point in the entire 10Q for understanding their future. It suggests two things. First, that their product, especially the newer AIP features, has found true product-market fit outside of their core defense niche. And second, that their investment in a scaled, high-velocity sales force, which we can see in the rising sales and marketing costs, is now paying off handsomely. They are successfully converting interest in AI into measurable contract revenue.
At a rate that few competitors can match.
Right. And to support this explosive growth, the customer base itself swelled significantly. Total customers reached 911 as of Q3 2025. That's up sharply from 629 just a year earlier.
This is crucial for showing that the growth is broadening. It's not just dependent on a handful of mega deals.
That's the key.
But when we talk about that 911 number, we should probably add some context, especially for the government clients. How exactly does Palantir define a customer?
That's important context. Palantir defines a customer based on separate contracts and independent procurement. So in the government space, they count separate contracts, even if they are all nested under a massive institution. For example, the FDA, the CDC, and the NIH. They're all under the U.S. Department of Health and Human Services, HHS.
Right.
They can each be counted as a separate customer. That's because they have independent budgets, separate procurement processes, and distinct contracts. So while this is a common practice, it means that 911 number represents individual contract streams, not necessarily 911 completely disparate organizations.
Got it. What's equally compelling, though, regardless of that definition, is the successful expansion within their most important clients. The average revenue from their top 20 customers grew 38%. It jumped from $60.1 million to $83 million over the trailing 12 months. That clearly demonstrates platform stickiness and successful upselling. They're landing and expanding big time.
Yes, expansion is good, but this strong reliance on large clients brings us directly to a key financial and operational risk. It's highlighted right there in the filing. Customer concentration.
Ah, yes.
Although their revenue base is diversifying, the filing notes that for the 9 months ended September 30, 2025, the top 3 customers still accounted for 16% of total revenue.
16% from just 3 customers.
It's a marginal decrease from 17% last year, but the risk remains significant. The 10Q explicitly states that if any of these large customers, which could be a single major government agency or a massive enterprise, if they were to reduce their spend or terminate their contracts for convenience or any other reason, Palantir's results could be materially and adversely impacted.
That's a fundamental risk for a company with these kinds of massive multi-year contracts. Speaking of which, the remaining performance obligations, or RPO, gives us a look at the contractual backlog, the revenue they expect to recognize from signed non-cancelable contracts. As of September 30, 2025, RPO stood at a very solid $2.6 billion, and the expected recognition breakdown gives excellent revenue visibility. 44% is anticipated in the next 12 months, 41% in the subsequent 13 to 36 months, and the rest after that. That provides a lot of confidence in next year's revenue base.
The RPO number is strong, yes, especially for a company with such a substantial government focus. However, we have to address the critique here and provide some necessary context. When you compare this RPO to a standard commercial SaaS company, you find a unique volatility embedded in Palantir's backlog.
How so?
The filing notes that many of these contracts, particularly with government clients, are cancelable. The company states that many customers can terminate contracts for convenience with less than 12 months' notice. So that means a large portion of that $2.6 billion in RPO, while it's indicative of signed commitments, it is not absolutely guaranteed in the same way a typical enterprise SaaS subscription is. It requires Palantir to continuously perform and satisfy the client to realize that full value. There's inherent instability. The threat of termination for convenience is a core risk of government contracting they have to manage.
That's a critical note on RPO. And it brings us nicely into our second deep dive, the story of profitability, margins, and operational efficiency. This section requires us to actively engage with that difference between GAAP and non-GAAP results, which is where the real debate about Palantir's economics often lies.
It is.
We saw earlier that the GAAP gross margin was 82%. But if we peel back the layers and look at the adjusted numbers, what does that tell us about their operational efficiency?
It tells us they're running a highly efficient core operation. The gross margin remained incredibly strong at 81% for the 9 months year-to-date, consistent with 2024. But if you adjust for stock-based compensation, or SBC, the primary non-cash cost, the adjusted gross margin was even higher at 83%. This high margin indicates strong unit economics. They're selling a product that is extremely valuable to customers, and it's inexpensive to deliver once that foundational R&D is complete.
Okay.
But the real operational shift isn't just in gross margin, it's in the adjusted income from operations, which is the non-GAAP operating margin. This is the measure of how efficiently they are running the core business, capturing revenue after covering R&D, sales, and G&A, minus that SBC impact.
And what does that look like?
In Q3 2025, adjusted operating income was a massive $600.5 million. That translates to a stunning 51% adjusted operating margin.
51%.
51%. Now let's contextualize that for you. That compares to $275.5 million and a 38% margin in Q3 of 2024. A 13-point leap in operating margin year over year, while scaling revenue 63%. It's astonishing.
It's incredible. 51% is not just high for a growth company, it's high for established giants like Microsoft or Salesforce.
Exactly. It signals that Palantir has achieved true operating leverage, where new revenue costs significantly less to acquire and serve than legacy revenue did.
That 51% figure demands that we look closely at where that leverage is coming from. The company emphasizes a specific metric to track this, which is the contribution margin. Could you define that for us and explain the significance of its recent movement?
Certainly. Contribution margin is a focused metric defined as revenue minus the cost of revenue and sales and marketing expenses, specifically excluding stock-based compensation. So essentially, it measures the raw profitability generated directly from acquiring and serving a customer before you factor in the massive fixed costs of R&D and G&A.
Okay, so pure customer-level profitability.
Exactly. And that contribution margin hit 66% in Q3 2025. That is up significantly from 60% in Q3 2024. This 6-point expansion is the clearest, most undeniable evidence of operational leverage in the entire filing.
So 66% means that for every dollar of revenue, 66 cents are left over after paying for the platform and the person who sold it. What drove that 6-point leap?
It demonstrates dramatically improved efficiency in their sales, marketing, and deployment processes. When revenue grows 63%, but your S&M expenses grow slower, your contribution margin expands. This suggests specific process improvements, maybe a dramatically shorter sales cycle due to the productization of AIP.
Fewer expensive engineers needed to close a deal.
Exactly. It means the cost to acquire and serve that 63% higher revenue base is growing much slower than the revenue itself. This is the definition of operating leverage in a software business.
A major validation of their commercial strategy. But that expansion is so impressive. If the adjusted numbers look this fantastic 51% operating margin, 66% contribution margin, we have to dedicate time to the main driver of that difference. Stock-based compensation, or SBC.
The SBC.
This is the main non-cash expense, separating that $475 million in GAAP net income from the $600 million adjusted income in Q3.
SBC is the elephant in the room for every highly compensated tech company, and Palantir is no exception. While it's non-cash, it is absolutely a real cost. It represents shareholder dilution, and it's a cost of hiring and retaining top engineering and sales talent. Total SBC for Q3 2025 was $172.3 million, which is a 21% increase year over year.
So let's really dissect this. Is increasing SBC even if the company is growing revenue at 63%? Is that a responsible way to manage cash burn, or is this a form of dilution that fundamentally undercuts the GAAP profitability story?
It's both. And the truth really depends on your vantage point.
Okay.
For management, SBC is a powerful tool. Because the cost is non-cash, it allows them to preserve that $6.4 billion cash pile we'll discuss shortly. They're paying engineers and salespeople primarily with stock, minimizing the outflow of physical cash. And in a high-interest rate environment, preserving cash is paramount.
But for the shareholder.
However, for the Class A shareholder, that $172 million is dilution. It means more shares are being issued, spreading the ownership pie thinner. The fact that SBC is increasing 21% year over year suggests new grants, RSUs, performance-based RSUs, stock appreciation rights, are being aggressively used to hire and incentivize the workforce needed to support that 63% growth.
So the key question for an investor is whether the value generated outweighs the dilution cost.
Exactly. And based on that 66% contribution margin expansion, management is effectively arguing that it does, but it remains a crucial consideration.
And the 10Q breaks down where that increasing SBC is being targeted, right?
Yeah.
It confirms aggressive investment across the board.
It does. The filing shows major increases in SBC expense across all operating categories. Sales and marketing expense included $12.5 million more in SBC in Q3 25 versus Q3 24. G&A increased by $10.4 million in SBC, and R&D increased by $4.3 million in SBC. This shows a holistic strategy to use equity compensation to fuel growth.
To reinforce that scale-up story further, let's look at the absolute dollar increases in overall operating expenses.
Right. Total operating expenses increased 25% for Q3 2025. Crucially, that 25% growth rate is far slower than the 63% revenue growth.
More proof of operating leverage.
Undeniable proof. And within that 25% increase, the spending is highly targeted toward customer acquisition and product refinement. Sales and marketing costs jumped 31% Q3 year over year. This was primarily driven by a $24.6 million increase in payroll. They were aggressively hiring salespeople, and as we just discussed, the $16.6 million rise in SBC.
Which reflects that urgent, aggressive effort to scale the sales force to capitalize on the success in the U.S. commercial market.
The one that grew 121%, exactly.
And on the product side, the lifeblood of a software company, research and development. R&D costs increased 23% year over year. What was specifically driving that?
The filing is very specific. It indicates two major investment areas. First, a significant $12.3 million increase in costs related to third-party cloud hosting services.
And that's a crucial indicator.
It is. It highlights the vast computational infrastructure required to develop, train, and deploy next-generation platforms like AIP. Running these generative AI models requires enormous, expensive cloud resources.
So they're not holding back on that investment?
Not at all.
Okay.
And second was the $8.4 million increase in SBC and related taxes for their engineers. This confirms Palantir is pouring resources into both the infrastructure, the cloud hosting, and the talent to maintain its technological edge in AI.
Okay, moving on from the dynamic operating story to financial strength. Let's look at their liquidity and capital allocation. This is where Palantir looks less like a high-risk tech growth company and more like a financial fortress.
A fortress is a good word for it.
Cash flow is just enormous now. Net cash from operating activities for the 9 months year to date hit $1.36 billion. That's nearly double the $693 million generated in the same period in 2024.
And that massive increase was driven fundamentally by the jump in GAAP net income, combined with those non-cash add-backs like the $1.02 billion in stock-based compensation we just discussed.
Right. So when you look at the balance sheet, the liquidity position is almost without peer.
It really is. Palantir holds a staggering $6.4 billion in cash, cash equivalents, and short-term U.S. Treasury securities. And critically, they operate with zero outstanding debt balances and maintain an available undrawn credit facility of $500 million. This gives them immense financial optionality.
Okay, but let me interject here to play devil's advocate. If they have $6.4 billion sitting around, yes, they're running a sophisticated treasury operation, but holding that much in short-term treasuries, earning passive income, doesn't that suggest a lack of higher yield strategic acquisition targets, or maybe management's caution about reinvesting that capital aggressively back into their own core business?
That's a fundamentally important question to ask. And the filing supports the idea that they are prioritizing capital preservation over aggressive M&A. Net cash used in investing activities was $1.83 billion year-to-date, up from $980 million in 2024.
A big jump.
A huge jump. However, the vast majority of this cash usage was highly liquid. The primary driver was massive purchases of marketable securities, specifically ultra-safe short-term U.S. Treasury securities, totaling $6.09 billion year-to-date.
So they're just parking the cash.
They're managing the float, yes, but in the safest possible instruments. It is a conservative fortress strategy designed to maximize security and optionality, even if it means missing out on riskier high-yield investments.
And the result of that conservative strategy is that they are essentially turning their massive operating cash flow into a source of non-operational passive income.
Exactly. The huge interest income of $59.8 million reported just in Q3, that is a direct and substantial result of placing that massive $6.4 billion cash pile into those safe, interest-bearing treasuries.
And that income is highly significant because it acts as a stabilizing revenue source, completely detached from the competitive pressures of the software market.
Right, benefiting hugely from the current high interest rate environment.
In terms of more strategic capital allocation, not just treasury management, we also see continued, albeit minor, growth in their holdings of privately held equity securities. These are typically strategic investments or non-cash consideration received in exchange for commercial contracts. Those holdings increased to $163 million, up from $65 million at the end of 2024.
And this time, those bets are paying off, at least in the short term. The company recognized upward adjustments on these equity assets, totaling $30.7 million in Q3. And while revenue from those original strategic commercial contracts continues to decrease as that program winds down, the appreciation in the underlying assets shows management making smart, tactical bets.
Let's discuss the stock itself and how they are utilizing that capital fortress. Palantir continues to utilize its share repurchase program. In Q3, they repurchased and retired 0.1 million shares for $19.2 million.
And perhaps more importantly than the immediate repurchases, they have approximately $880 million remaining authorized under that program.
That's a huge authorization.
It is. And it's backed by that mountain of cash and the $1.36 billion in operating cash flow. It's a very strong signal of financial strength and management confidence in the company's valuation. It provides a massive buffer.
We also need to look at insider activity via the Rule 10d5-1 plans. These are the pre-arranged trading arrangements for executives to sell stock legally.
Right, without triggering insider trading accusations.
And the 10Q provides specific detail. It confirms terminations and adoptions of new plans by the CTO, CFO, and a director in August and September.
For example, CTO Shyam Sankar adopted a new plan covering 1.125 million shares of Class A common stock. This disclosure is crucial because while it's standard procedure, it confirms that high-level insiders are making plans to liquidate significant portions of their equity holdings. So even as the company hits new highs, key executives are taking steps to monetize.
Time to shift our focus to the future and the strategic risks outlined in the filing. Where is Palantir putting its strategic energy, and what are the major headwinds they're now facing?
The product strategy is unambiguous. It's the clear answer to how they intend to sustain that 63% growth. It's all about software platforms serving as the central operating system for customers, especially through the artificial intelligence platform, AIP. The filing reiterates AIP as their newest, most advanced offering. It's designed to combine their existing, highly secure software architecture with cutting-edge generative AI models. The goal is to facilitate high-stakes, real-time decision-making. But crucially, Palantir markets this within required security and ethical constraints.
So their competitive advantage is being the safe way to do enterprise AI.
Exactly. They're positioning themselves as the only way for security-conscious clients to operationalize AI without the enormous risks of general-purpose, consumer-grade models.
Turning to the legal landscape, let's review the litigation updates. The Consolidated Securities Class Action, CUPET v. Palantir, was dismissed with prejudice by the district court on April 4th.
That initial dismissal with prejudice is a strong win for Palantir. It alleviates a major near-term liability risk.
But it's not over.
It's not. The plaintiffs filed a notice of appeal in May to the 10th Circuit Court of Appeals, so the higher court will now review the decision. This could take months or even years.
Okay. And what about the other case?
The separate stockholder derivative action, the Central Laborers Pension Fund case, was dismissed by the Delaware Court of Chancery in its entirety on April 25th. So the dismissal of both major legal challenges within the same quarter cleans up the immediate liability profile substantially.
This brings us to a structural element we have to dedicate significant time to, the governance structure. This is perhaps the most unique and defining feature of Palantir.
Oh, absolutely. This structure is designed explicitly for long-term founder control. It's a triple-class structure. You have Class A common stock, which the public holds, 1 vote per share. Then there is Class B, held by insiders, 10 votes per share.
And then there's Class F.
But the true locus of power is Class F common stock. All shares of Class F are held in the Founder Voting Trust, established by the 3 founders: CEO Alex Karp, President Stephen Cohen, and Chairman Peter Thiel.
What power does that Class F stock grant them? What's the long-term implication for the average Class A shareholder?
The Class F stock, in combination with the Class B shares the founders hold, generally grants the founders control of up to 49.99999% of the total voting power, as long as they maintain a minimum ownership threshold of 100 million equity securities.
So they have total control.
Effectively, yes. It means the founders control all matters submitted to stockholders, including electing directors and major corporate transactions. This severely limits the influence of Class A public holders.
And this is by design, a long-term commitment structure, not an accident.
Exactly. It's intended to maintain stability and a long-term vision, preventing the company from being influenced by short-term market pressures or activist investors. The risk section of the 10Q explicitly notes this.
And the most provocative detail from the filing relates to the longevity of this control. This centralized governance structure is designed to persist for decades.
That's right. The founder voting agreement typically only terminates upon the death of the last living founder.
The last one.
The last one. Based on the ages in the filing, Karp is 57, Cohen is 57, and Thiel is 43. This structure is engineered to last well into the latter half of this century.
So for potentially the next 30 to 50 years, the strategic direction, capital allocation, and governance will remain largely impervious to external shareholder influence.
The success of the company is entirely tied to the continued alignment and vision of its 3 core founders. It's a governance model unlike almost any other public company.
And this inherent focus on a long-term insulated strategy has implications that go beyond just internal control. It also impacts how they navigate the external regulatory environment, which is getting more complex, especially around AI.
Precisely. Tying this back to the regulatory environment, the 10Q addresses new tax and technology risks. On the domestic tax front, they analyze the new U.S. One Big Beautiful Bill Act, signed July 4th.
And what's the verdict?
Palantir's preliminary analysis is highly favorable. The legislation is not expected to have a material impact on their effective tax rate this year. That removes a significant legislative uncertainty.
What about internationally?
Internationally, they're subject to the OECD pillar. 2 global minimum tax rules. But similar to the U.S. tax changes, the filing notes it hasn't had a material impact so far.
So tax is under control for now. What's the biggest risk then?
The most significant strategic risk is the explicit mention of evolving AI regulation. Given the massive investments in AIP, this is a top-tier operational risk. The filing specifically names the European Union AI Act, or EU AIA, and similar state-level bills like Colorado's Consumer Protections for AI bill.
And what's the fear there?
Palantir recognizes that these bills could impose onerous obligations, especially on transparency, data security, and testing requirements on systems deemed high risk, which many of Palantir's deployments would fall under. This could dramatically increase compliance costs or result in liabilities if their AI models are found to contain unforeseen flaws or bias. Navigating this fragmented global regulatory environment is essential for AIP's success.
And finally, the geopolitical and macro risk section is extensive, as you'd expect for a company so tied to global government and enterprise affairs.
Right. The 10Q explicitly ties various risks, market volatility, competitive position to ongoing global conflicts. It mentions the Russia-Ukraine conflict and the Israel and broader Middle East conflicts, alongside heightened interest rates.
It also mentions the complexity of operating in conflict zones.
Yes, in stark terms. Providing platforms and personnel in these areas exposes them to heightened risks of sophisticated cyber attacks from nation-state actors. It's a critical reminder that their customers operate in the most high-stakes environments globally.
This has been an incredibly data-rich and complex filing. We've covered everything from their massive cash generation to the founder trust that governs the company until at least 2070. Let's synthesize this down to the 5 most important financial and operational takeaways that every listener needs to know right now.
I think we can summarize the key strategic story in 5 major points that really define this quarter. First, accelerated growth and commercial momentum. Revenue growth hit 63% year over year. That's incredible at this scale. And crucially, this growth is heavily fueled by the U.S. commercial segment, which exploded with 121% growth, validating their core strategy.
Number 2, significant GAAP profitability. They're not just growing, they are making real money. Net income attributable to common stockholders nearly tripled, reaching $475 million in Q3. This propels them into the category of a highly profitable scaled software company.
Third, operational efficiency gains. This is the leverage story. The non-GAAP contribution margin expanded substantially to 66%, up 6 points from 60%. This is definitive proof that their expense base is growing far slower than revenue,
Which drives that massive leap in the adjusted operating margin to a sector-leading 51%. Okay, 4, exceptional liquidity and financial fortress. Palantir maintains an immense financial buffer. They hold $6.4 billion in cash and short-term investments with 0 debt. This liquidity is currently generating massive, non-operational interest income, nearly $60 million in Q3 alone, and it strongly supports the $880 million remaining under their share repurchase program.
And number 5, strategic focus on AIAP versus regulatory risk. The company is explicitly investing heavily in AIP, driving up R&D and cloud hosting costs to build future advantages. However, this focus exposes them to the significant and increasing risk of evolving, potentially onerous AI regulation in places like the EU. It's a constant balance between innovation speed and compliance burden.
To wrap up, here are the key headline financial results you should carry away from this deep dive in brief. Revenue for Q3 2025. $1.181 billion, that's 63% growth year over year. Net income for Q3, $475.6 million on a GAAP basis. Diluted EPS for Q3, 18 cents. Gross margin for Q3, 82% GAAP, 83% adjusted. And that adjusted operating margin for Q3, a stunning 51%. While they didn't provide specific numerical guidance for the full year in this filing, the outlook confirms expectations for continued increases in operating expenses as they aggressively invest in growth, getting heavily on U.S. commercial customers.
If we connect this to the bigger picture and offer one final provocative thought for you to chew on, we have to return to that unique governance structure. Despite this explosive financial growth and movement toward true financial maturity, the multi-class stock structure and the founder voting trust are specifically designed to maintain control until the death of the last living founder. Considering their relative youth, 57, 57, and 43, this centralized, insulated governance model is designed to persist for decades. It might make Palantir the ultimate case study in prioritizing founder vision and long-term stability over external shareholder democracy. For you, the investor, the question isn't just about quarterly execution, which is strong, but whether you're comfortable buying into a system where external influence and checks on management are structurally prohibited for the foreseeable future. That commitment to decades-long control is the single most defining non-financial characteristic of Palantir.
An incredibly insightful note to end on. It highlights that the operational story is only half the picture. That wraps up our deep dive into Palantir's Q3 2025 quarterly filing. Thank you so much for engaging with us today and diving into this complex material. We hope this analysis provides you with the shortcuts and insights you need to truly understand the story inside the numbers. If you found this useful, please do us a huge favor. Like, share, and subscribe to the channel, and stay tuned for our next analysis. We'll see you soon.